Let me hear you say Peebo. What's up, family? Hey, it's book club time. I'm not gonna slack on my commitments, so I got to keep it real here. But this one is a gem. I swear to God, this one is money. Random Walk Down Wall Street. Burton G. Malkiel used to serve on the board of Vanguard for many years, and then he's actually been involved in fintech most recently. But this was a book when I worked for Morgan Stanley back in 2010 that was recommended to me by a supervisor. I said, hey, I want to learn about finance. I was working in their back office at the time, doing cost basis, data step-ups, estate planning, things like that. And this is the book that she recommended. And this opened up my eyes to my career as a CFP and as an advisor. And it is one of the best you can get out there if you want to learn about the global economy, about finance, about stock markets, bond markets, alternative investments, hedge funds. Everything is in here, and he covers it well. And the title says it all. It's like, what is a random walk? What in the world is he talking about? And this is where I picked a few quotes, just quick ones. This first one is just a gem here, but let me just read it. It's a paragraph. It's a little lengthy, but this will give you an idea for the book. What is a random walk? A random walk is one in which future steps or directions cannot be predicted on the basis of past actions. When the term is applied to the stock market, it means that short-run changes in stock prices cannot be predicted. Investment advisory services, earnings predictions, and complicated chart patterns are useless. So I'll stop real quick there. What he's talking about is if someone comes to you and says, hey, I want this stock's going to pop in 3 months, or an advisor or whoever, there's really no way that they can know that. And there's technical analysis. There are CFAs out there, and there's investment analysts who are very astute. But he goes on to say here, watch. On Wall Street, the term random walk is an obscenity. It is an epithet coined by the academic world and hurled insultingly at the professional soothsayers. Soothsayers, yikes. Taken to its logic extreme, it means that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by the experts. So he's not saying that investing in stocks is bad by any stretch. What he's saying is you want to be diversified. And it's a long play. You know, if you expect to jump in the market because it was down, almost 20% last year, whatever it was, and you think it's going to pop 30% this year, you might be wrong. We're in a unique cycle here. So just keep that in mind. Not advice, personal opinion, not guidance. That's my little disclaimer here. And then it talks about behavioral finance and what drives us to make those investment decisions. It could be past trauma with money, growing up poor or wealthy. It's on both sides of the spectrum. There's another great quote here. He says, remember the advice of the legendary investor Warren Buffett. You may have heard of him, the Oracle of Omaha. Lethargy bordering on sloth remains the best investment advice. The correct holding period for the stock market is forever. So like I said, it's a long play. It's a long play. It's not, there could be some income generation and passive income at that. And for many trusts and for many family offices, that is a major source of income. But he's just saying, to get that large capital gain, to get that big return and that big trade-off, the longer you're in and the less that you're trading, right? Because there's that zero-sum game. If you're selling a stock, someone's buying, right? If I'm buying a stock, someone's selling it to me, right? So this is the last quote I'll share with you. He says, in some degrees of mispricing, if some degrees of mispricing exist, it does not persist for long. True value will always win out in the stock market. To paraphrase Benjamin Graham, ultimately the market is a weighing mechanism, not a voting mechanism. So think on that. I won't dive too much deeper into it, but it's a healthy one. It's 400 plus pages, but the font's not all that small. And there's a lot of really, really good analogies. And honestly, of all the books in finance, you want to learn about efficient market hypothesis, being properly diversified, domestically and internationally. That's a great book to start with. So there it is, number 2. And let me hear you say, Peebo! Love y'all. Out.